In this video, we are going to learn about introduction to business and accounting. And before we start, this is our team member who helps in the making for the video and the material. So without further ado, let's get started. Chapter 1: The nature of business and accounting. What is the definition of business and accounting? Business can be defined as the assembling of all basic inputs such as land, labor, capital, entrepreneur to produce or procure goods and services for customers. Accounting, on the other hand, gives the report to the internal as well as the external users of the company regarding the economic and business activities and status of the business. For the overview of nature of business and accounting, the activities done by the company in the normal course of business in order to make sale of goods and service they possess is the nature of that business, and all the activities of recording, classifying, summarizing, and then interpreting the results of the transactions and the events of the business in monetary terms is the nature of accounting. The nature of business contains several things such as 1. Economic activity, which goods and services are produced or procured and then distributed among the customers. 2. Buying and selling. This economic activity of the business is the buying and selling of goods and services in its normal course. 3. Continuous process. Doing a business activity is not a one-time process. It is a continuous process in which goods and services are produced and then distributed among the customers. When a business is conducted for a single time, it is known as a venture. To be named as a business, the activities must be conducted regularly to earn profits. 4. Profit motive. To survive in the market, a business needs to earn profits. Profit in the business is required for the survival and growth of the business. It indicates the real worth of the business. Profit is the difference between income and expense of the business. Earning profit is the primary motive of the business. 5. Risk and uncertainties. The risk and profits go hand in hand, which means that in business, if there is high risk, then profit will also be high. On the other hand, if there will be low risk, the profits will also be low tier of business face two types of risk, insurable risk and non-insurable risk. Now, for the nature of accounting. 1. Accounting is a process. Accounting is the process of collecting, recording, classifying, summarizing, finalizing, and reporting the data and the financial information of the company. 2. Accounting handles the financial information and transactions. In accounting, the financial information is collected and recorded as a transaction, and after that, it is classified by the authorized person to finalize the result of a specific period to provide information to the users. And 3. Accounting is an information system. Accounting is a well-defined information system that collects and stores information. It communicates this information inside the business organization. Finally, chapter 1 is done. Now, I want to give you guys some questions. Okay, question number 1. To be useful, accounting reports must have characteristics that include representation. Representation itself means what? And then, this is number 2. What external factors can influence the nature of business of a company, and how do these affect the accounting? Now for the answers. Number 1. Representativeness. In the context of accounting, reports refers to the extent to which the information in the report reflects transactions, events, or conditions that actually occur. This means accounting reports must be trustworthy and accurately describe what happens in a business or organization. Representation in this context means that the report must be honest, accurate, and relevant for economic decision making. And the answer for number 2. External factors that can influence the nature of business of a company is 1. Change in the regulatory environment. 2. Market change and customer demand. 3. Technological change. 4. Change in the competition. And 5. Economic change. Whereas the impact on accounting there can be in the one asset value adjustment, change in account classification, additional disclosures, or risk evaluation. And that's for the answers. Chapter 2: Business Entity and Cost Concept. What is a business entity? A business entity is an organization that one or more people form to conduct business activities. So, how do business entities work? Business entities function by determining how the government requires business to distribute their income and how the government tax companies. In business, there are four primary business structures such as sole proprietorship, a business with one owner who doesn't operate the business as a separate legal entity; partnership, an organization owned and operated by many people who agree to share its profits and liabilities; corporation, an independent business entity that exists separately from its owner, which usually receives a share of the business in return for its investment; and limited liability company, or we call it LLC, a legal entity that gives business owners added benefits compared to a sole proprietorship or general partnership and helps protect owners' personal assets. Now, we are going to talk about cost concept. The concept of cost is financial valuation of resources, materials, waste, time, and utilities consumed to purchase goods and services. From an economist's point of view, the cost of manufacturing any goods and service is often said to be the concept of opportunity cost. These are the types of cost concept. 1. Accounting cost and economic cost. 2. Outlay cost and opportunity cost. 3. Direct or traceable cost and indirect or untraceable costs. 4. Incremental cost and sunk cost. 5. Private cost and social cost. And 6. Fixed cost and variable cost. Concept of cost in terms of traceability. Direct costs. Direct costs are related to a specific process or product. They are also called traceable costs, as we can directly trace them to a particular activity, product, or process. Indirect costs. Indirect costs are those which do not directly relate to a specific activity or component of the business. For example, an increase in charge of electricity or tax payable on income. Concept of cost in terms of the purpose. Incremental costs. These costs are incurred when the business makes a policy decision. For example, change of product line, acquisition of new customers, upgrade of machinery to increase output are incremental costs. Sunk costs. Sunk costs are costs which the entrepreneur has already incurred and he cannot recover them again now. These include money spent on advertising, conducting research, and acquiring machinery. Concept of cost in terms of treatment. Accounting costs. Accounting costs are those for which the entrepreneur pays direct cash for pressuring resources for production. These include costs of the price paid for raw materials and machines, wage paid to workers, electricity charges, the cost incurred in hiring or processing a building or plot. Economic cost. The economic cost is the combination of gains and losses of the products. This cost is mainly used by economists to compare one with another. Concept of cost in terms of the nature of expenses. Outlay cost. Outlay cost is the actual expense incurred by the entrepreneur in employing inputs. These include costs on payment of wage, rent, electricity or full charge, raw materials, and the other. Opportunity cost. Opportunity costs are incomes from the next best alternative that is foregone when the entrepreneur makes certain choices. Concept of cost in terms of payers. Private costs. These costs are incurred by the business in furtherance of its own objectives. For example, cost of manufacturing, production, sale, advertising, and the other. Social costs. Social cost is when society bears social costs for private interests and expense of the business. This includes social resource for which the firm does not incur expense, like atmosphere, water resource, and environmental pollution. Concept of cost in terms of variability. Fixed costs. Fixed costs are those which do not change with the volume of output. For example, like payment of rent, tax, interest on a loan, and the other. Variable costs. These costs will vary depending upon the output that the business generates. Less production will cause fewer expenses, and the business will pay more when its production is greater. Expense on the process of raw material and payment of which are examples of variable costs. And now we enter to the chapter 2 questions. Okay. For number 1, how to structure your business entity? Question number 2, describe the nature of the following costs and give reasons for your answers. And now the answer. Number 1, the choice of how to structure a business entity is one of the most important decisions a small business owner must make. An experienced local business attorney understands the advantage and disadvantage of organizing a startup under each type of entity and can help you determine which one offers the most significant benefits while exposing you to less liability. Additionally, a skilled lawyer will help you draw up the documents and bylaws needed for your business to comply with state laws and assist you in registering with the state. And now number 2. The cost incurred in advertising. This expense can be direct costs, sunk costs, private costs, and variable costs. Income earned from a job. This expense can be economic costs and opportunity costs. Rent paid for factory premises. This expense can be accounting costs, direct costs, outlay costs, private costs, and fixed costs. And then that's that. Chapter 3, the accounting equation. What is the accounting equation? The accounting equation states that a company's total assets are equal to the sum of its liabilities and its owner equity. This straightforward relationship between assets, liabilities, and equity is considered to be the foundation of the double entry accounting system. The accounting equation ensures that the balance sheet remains balanced. That is, each entry made on the debit side has a corresponding entry on the credit side. Understanding the accounting equation. The financial position of any business, large or small, is based on two key components of the balance sheet, which is assets, liabilities, and owner's equity. Assets represent the valuable resources controlled by the company, while liabilities represent its obligations. Both liabilities and owner's equity represent how the assets of a company are financed. These are the examples of the items listed on the balance sheet. Assets. Assets include cash and cash equivalents or liquid assets, which may include treasury, bills, and certificates of deposit. There are also accounts receivables which list the amounts of money owed to the company by its customers for the sale of its products. Supplies is also considered an asset. Liabilities. Liabilities are debts that a company owes and costs that it needs to pay in order to keep the company running. Owner's equity. It can be defined as the total number of dollars that a company would have left if it liquidated all of its assets and paid off all of its liabilities. And this is the accounting equation formula and calculation, which is assets equal to liabilities plus owner's equity. Now, same as before, it's question time. Okay, for number 1, what are the 3 elements of the accounting equation? And number 2, what is an asset in the accounting equation? What are the examples? And the answer is number 1, The three elements of the accounting equations are assets, liabilities, and owner's equity. And number two, an asset is anything with economic value that the company controls that can be used to benefit the business now or in the future. They include fixed assets such as machinery and buildings. They may include financial assets such as investments in stocks and bonds. Chapter 4: Business Transactions and the Accounting Equation. What's the correlation between accounting equations and business transaction? Economic activities are conditions that directly change an entity's finance or directly affect operational results with business transactions. All business transactions can be stated with amendments to elements in the accounting equations. The example between accounting equation and business transaction. Financial statement. The basic application of accounting that is never eliminated is in financial reports. This report covers a lot of ground and not just in company reports. Financial reports include amount of incoming balance and outgoing balance. Bookkeeping in accounting. The accounting equation is used in bookkeeping. Bookkeeping, each company always owns it in order to achieve a balanced company account report between expenses and income on a certain period. Profit. The application of the accounting equation is related to calculations of the profit generated by an entity during a financial period. Profit can be explained as income minus expense. Profit earned the company is something to look forward to. Just counting total company profit is not an easy matter. Investment. The accounting equation is also involved in calculating amounts of profit from investment returns. Investment is a process for investment and gain profits over a period of time. When making an investment, implementation is also very necessary. This basic equation is for calculating the amount of profit from resulting investment. And now we come to the question for chapter 4. How many applications of accounting are there in business transactions? Name anything. And number 2, what happens if the final inventory calculation is stated to be too low? And the answer is, for number 1, the application of accounting in business transaction has 4 applications, namely financial reports, bookkeeping, profits, and investments. And for number 2, if an error occurs when the ending inventory is calculated too low, it will have an impact on the company's financial balance sheet, namely the amount of inventory, current assets, total assets, retained earning will be stated too low, and net working capital and current balance will also be lower than they should be. Now we come to the last chapter, chapter 5. Introduction to Financial Statements. What is a financial statement? Financial statement is a format for recording financial information of a company in a certain accounting period, which can be used to describe the performance situation of the business or company. The function of financial statement. 1. Evaluate the condition of business and enterprise development. 2. As an accountability report to stakeholders. There are so many types of financial statement. Income statement. This type of statement is usually used by companies to determine the company's profit and loss position so that it can assess financial performance. From the information in this report, it will be known whether the company experienced a profit or a loss in one accounting period. Statement of owner's equity. Statement of owner's equity is a financial statement that describes change in the form of increase or decrease in the net assets of a business during one accounting period. And balance sheet, a type of simple financial statement that consists of several pieces of information that show the position and financial information of a business or company. In the balance sheet statement, you will see complete and detailed information about the company's assets, liabilities, and capital. And last thing is cash flow statement. Cash flow statement is a report format that provides information about incoming and outgoing cash flow of a business. The cash flow statement also functions as an indicator to predict cash flows in the future period. And then we are in the last place, the questions. Yes. Okay, the question number 1. What things need to be considered when preparing an income statement? And the question for number 2. Are notes to financial statements mandatory in the financial statement section? Why? And the answer is income, both operational and non-operational, loan expense, tax expense, company profit and loss, and operating costs. And the answer for number 2, the notes to the financial statements are a required, integral part of a company's external financial statements. They are required since not all relevant financial information can be communicated through the amounts shown or not shown on the face of the financial statements. And that's all the material is about introduction to accounting and business. Thank you guys for watching and see you next video.